Today we're going to talk about one of the most misunderstood things inside of a tax return. And it's misunderstood because there's the part that our brain conceptually assumes something would be true, and then there's the IRS definition of stuff, right? And they don't have to match. So today we're going to talk about passive income. And before you kind of glaze over and you're ready to move on, I promise I'm going to make this as easy to understand as possible. And I'm going to throw in an example to maybe make it a little bit easier for you. So hang in there because this impacts so many people. And I want to start by defining what is passive income. Now, for the sake of the IRS, we're going to have to make a few assumptions for today's video, but we have to assume a couple of things, otherwise these things would go on for days, right? So for today's income, we're going to assume passive income is if you receive a K-1 from a business that you don't really participate in. Maybe it's something that you're a family member and so you get part ownership. Or maybe you've got a rental and or you're doing a VRBO. Again, for rental properties, there's an entire list of different rules that can make this not passive. But for today's video, we're just going to assume that it is, and we're going to cover that. We said that now, and we're just going to move forward with that. Also, if you have any type of royalty income from oil and gas, those sorts of things, that is also passive income. I think it matters, and where that gap came in that I talked about at the beginning is in things that we assume in our brain sound passive, but they're not in the eyes of the IRS. And I'm talking about things like our interest income that we get from banks. I'm talking about dividends on investment accounts. I'm also talking about stock sales inside those investment accounts, right? They feel passive, but the IRS defines those as portfolio income. So they make a distinction between the two. And now, why am I making such a big deal out of this? Why do you even care, right? You care because we're only allowed to deduct passive losses to the extent that we have passive income. This is where the example comes into play, so this makes a little bit more sense. Let's say I've got a W-2 of, $80,000 a year. And I've got a rental home that I rent out every year. And for whatever reason this year, it's sat empty for a couple of months and I've been putting off some repairs to the home and I decided to invest that money. And I ended up losing $10,000 on my rental property for the year, right? My brain might assume I've got an $80,000 W-2 and I've got $10,000 loss on my rental property. My adjusted gross income will be $70,000. That's just not true because I'm only allowed to deduct the expenses to the extent that I have income. My adjusted gross income is still going to be $80,000. Keep that in mind because if you have passive losses, you're not going to be able to deduct them necessarily in the year that they happen. I do have good news for you though. I'm allowed to carry those losses forward. What does that mean? Let's say, again, I just have one rental property. That's my only passive activity that I have on my tax return. Now, I have got that loss that year. If I can't use it, I get to bring it forward to the next year. That's good news. Because now let's say in the next year, that same rental property makes $15,000. I'm now allowed to deduct that $10,000 loss that I didn't get the year before against this year's 15 of profit and only report a gain of $5,000 on that rental property in terms of income for the year. So that's big news, and it ends up impacting year over year on a tax return when we have losses and gains, or losses and then gains. And the other bit of really good news is, and this is also true for if you own that non-material ownership in a business. Let's say you've got losses in a year, there's a chance that you're not able to deduct them because to the IRS that's passive, right? As I'm accumulating these losses in years I have gain, I can always be able to deduct them against that. Also, let's say I've got this rental home again, right? I keep using that as today's example. Let's say I've got this rental home and I just lose money on it every single year. which ideally, if you're running a rental property, the goal is always to have positive cash flow and a tax loss. That's the sweet spot, because you don't want to be paying any income tax, but you want to be creating positive cash flow. So let's say I'm actually executing that correctly, right? And I'm creating these tax losses that I'm not being able to deduct each year. When I sell my passive activity, whether it's that ownership in that K1, it's the rental property, I'm allowed to deduct any losses that I've been carried forward in the year of that sale. Because at that point, once the activity's gone, the IRS says, hey, okay, square up, so to speak. And I can take all those losses in the year of the sale. So that can be a big game changer for a lot of folks. I mean, that can be a big swing on a change of that year's taxable net income. So I kind of want you to keep both those things really in mind going forward if you have any type of passive activity. The big one is, please always remember that you have to have passive income in order to be able to subtract our passive losses. Now, I'm just going to bring this up real fast. There's something else at play here when you get into passive and you're doing these types of things, and that is the term at risk. Not even going to cover it. We're not even going to discuss it at all. It's a whole nother can of worms. Just know if you're involved in these things, you really need to be talking to your tax professional every single year about, hey, do I have losses? I think I'm going to have gains this year. Am I even at risk? And I'm more than happy to discuss all this with any of you. I'm right here at Advantage Tax and Accounting in Newburgh, Indiana. Our phone number here is 812-490-9600. And again, my name is Mike. Please call with any questions you may have. And I believe that together we have the advantage.